Welcome. My name is Dave Jones, and I have the privilege of serving as director of the Climate Risk Initiative at UC Berkeley School of Law Center for Law, Energy, and the Environment. And today we're co-hosting with the Center for Law and Business at Berkeley School of Law this webinar on the recently released CFTC report, Managing Climate Risks in the US Financial System. Of course, the evidence of climate change is all too much with us, whether it's more severe and frequent wildfires or droughts, heavy rains and winds in the Midwest, storms and hurricanes in the Gulf and along our eastern coast. But far too little attention has been paid until this time to the way in which the physical and transition risks of climate change manifest themselves in the US financial system. And so that is the focus of our webinar today. And we're delighted to have with us here today three fantastic panelists. Commissioner Rustin Benham on the CFTC, who's the sponsor of the report. Divya Mankikar, who's investment manager and leads the climate risk and sustainable investment practice at CalPERS, one of the leading international investors active in the area of assessing and addressing climate risks, and Imi Granoff, who's the director of sustainable finance at the Climate Risk Foundation, which has been significantly involved in supporting the efforts of financial regulators globally to better address climate risks. So the full bios of each of the panelists are at the landing page, so please take advantage of those. The format for today's webinar will be opening remarks from each of the panelists, followed by a question and answer session, and then an opportunity to pose audience questions. The way that we'll pose the audience questions is that after the opening remarks, the Q&A feature of the call will be launched, and audience members can write questions that I'll then receive, and then I can pose to panelists later on. So with that, it's really my pleasure and honor to introduce Commissioner Rustin Benham, who is the sponsor of this path-breaking and first ever comprehensive report by a U.S. financial regulator to address and make recommendations regarding climate risks in the U.S. financial system. Russ.
Thanks, Dave. Appreciate that introduction, and it's absolutely great to be here, to be with you and Divya and Imi on this webinar discussing these important issues. And also big thanks to the Center on Law, Energy, and Environment in Berkeley for hosting the event. You know, one of my goals in the past couple weeks since the report was issued in early September is to get out as much as possible and raise awareness about the report itself, some of the findings and the great work, Dave, that you were a part of and Divya was a part of as well. I think it's important. I'll just take a few minutes here in these intro remarks to talk a little bit about how we got here and sort of what motivated me to put together the committee and to talk about climate change as it relates to financial market risk. You obviously mentioned a lot of the extreme weather events we're seeing, of course, in California in the most recent few months, and of course in the Gulf Coast, and these repeated events that are happening more frequently and in more extreme natures in the past few years. I think finally is trying to pushing folks to understand the risks, the transition risks, and of course the physical risks that we're facing as we aim to transition to a net zero economy. And for me personally, I had worked in ag policy and agricultural policy for a number of years before joining the CFTC, which for those who don't know is the primary derivatives regulator in the US financial system. We have a bit of a patchwork of financial regulators. Supervisors, banking supervisors like the Fed and the FDIC, but market regulators like the Securities Exchange Commission and us, the CFTC, which oversees futures, which are derivatives, swaps, and options on futures. With my time in ag, I spent a lot of time working for Senator Debbie Stabenow, who's a Michigan Democrat, and climate change was a focus for her and has been and continues to be. And I thought about climate change in the context of agriculture, which you can imagine, and as everyone knows, they go together very closely, and the flooding that we've been seeing in the Midwest and of course the storms in the Gulf Coast really shaped my thinking about climate, where we're heading and what we really need to be doing as a country to address climate risk. When I joined the commission in September of 17, so just about 3 years ago, I really started to put two very different disciplines together and thinking about financial market risk and climate change. And What was a bit of a surprise to me at the time was there's been a lot of work that's done overseas and certainly by the private sector, most notably by the Bank of England and also by the Financial Stability Board's Task Force on Climate-Related Financial Disclosures. So for me, given all the work that had been done as I continue to educate myself about climate-related financial market risk, I thought it was really important to take a step within the US government and to really start to examine these issues and raise awareness. I think it goes without saying, I don't know the specific data on this, I say this often, but I would assume or bet that if you ask a sample set of people and you ask them about climate change, the most frequent responses would of course relate to sort of the environment, environmental degradation, and energy production, and not necessarily financial markets and financial market risk. But we're obviously seeing that up front and very close these days, specifically in the West Coast, Dave, where you are, and Divya as well, and what we need to be doing to address these risks as they become more frequent and more extreme. So as I started to sort of shape the idea of the report, a few things really came to mind as priorities. One was to build the broadest coalition of members. There's a 34-member subcommittee, and really what I'm most proud of is there's a representation mostly of the real economy. Obviously, we have major financial market participants, including large banks and asset owners, but we have energy participants, agriculture participants, data providers, clearinghouses, NGO community, environmental community, academics. And I really think it's a broad-based coalition that really supports the idea of climate change as a real risk to financial markets and what we can do to harness that risk in a sense and create opportunities. Finally, the other thing I would say is the scope of the report. And in the absence of work done at the federal level, I know a lot of work is being done at the state level, but in the absence of work at the federal level, I thought it was really important to be as broad as possible. You know, obviously within the CFTC, we have a very finite mandate and regulatory requirements with respect to derivatives, but climate change is not going to limit itself to one market at all. And I think in order to take a comprehensive look and to do justice to this examination, we needed to look at the full scope of financial market risk and think about different pockets of the financial system and what we could do to address the existing risk and the upcoming risk. And I'll finally end with you know, what we're seeing in the COVID pandemic. The market experience that I viewed and saw from a regulator standpoint in the March-April period when the economy really shut down and there was the first sort of emergence of widespread the virus across the country, was a lot of turmoil and a lot of volatility and a lot of uncertainty in the markets. And as many people, I think, don't necessarily relate climate change to financial markets and the stability of financial markets, I think using the pandemic and what we experienced in the first part of this year as an example of how crises, regardless of what they are going to affect the real economy, are going to affect financial markets. I, again, can't say for sure, but I bet you if you asked a lot of people 5-10 years ago, what do you think the relationship is between a health crisis and financial market stability or resiliency, there necessarily wouldn't be a clear distinction or a clear line to draw between the two. And unfortunately, I think to this day, we don't exactly have a consensus view on what financial market stability and resiliency and its relationship is to climate change. But this report is certainly a huge step forward. Like I said at the beginning, it's going to raise awareness, I think, for policymakers and elected officials in Washington. And really, it's going to bring us up to speed with the work that's being done overseas. The response has been very positive overseas, and I think it's sending a clear message to the international community that there are a lot of people at the private sector level, at the NGO level, at the academic level, and then speaking for myself within the government as a policymaker to really lift up this issue, raise awareness about it, and hopefully spark some action, because we have to move quickly and we need to harness the power of the financial markets to help the broader transition to net zero economy, of course, but also to address these risks that we're facing from a physical standpoint, unfortunately, every day. So look forward to the conversation. And again, thanks for the invitation.
Well, thank you, Commissioner. And Divya and I both had the privilege of serving on the Federal Advisory Committee that, working under your leadership, drafted the report. And it was a real privilege to get to do so. And I just want to underscore the momentousness of the accomplishment of getting this report out. The first time ever a U.S. financial regulator has comprehensively looked at, analyzed, and explained the way in which climate change related risks, both physical and transition, can be channeled into and manifest themselves in financial markets with financial institutions and the financial system, but also reaching a unanimous vote of support on that committee, populated as it was by 35 or so very different organizations with very different perspectives, is just an extraordinary testament to your leadership. And so thank you very, very much for all of the effort that you put into this and your continued work to make sure that the public and stakeholders are aware of the report. And so for those in the audience, you can get a copy of the report by either going to the CFTC's website or UC Berkeley School of Law's Center for Law, Energy, and the Environment's website, which was a link attached to the invitation. And you can see there the report. I'm going to just touch briefly on some of the key findings of the report and key recommendations, and then we'll have a chance to hear from Divya and Ilmi. I think one of the very important findings of the report is that climate change poses emerging risks to the U.S. financial system, as well as potentially systemic risks to the U.S. financial system. And there's a lot of documentation within the report for that finding. I think it's a very significant conclusion and one that ought to be paid attention to by actors across the spectrum. Another important finding is that the report concluded that financial regulators and financial authorities, both federal and state, have within their existing mandates and remit and legal authorities the authority to address climate risks. And that while additional legislation could be useful in some contexts, there really is already sufficient authority within each of the regulators. And the report very carefully walks through, regulator by regulator, ways in which those regulators can begin to address these risks for the segments of the market that they regulate. And finally, it makes a very important recommendation that federal financial regulators, and included in this are state insurance regulators who are part of a federal system of regulation of insurance, need to move urgently and decisively to measure, understand, and address climate risks. And some of the specific recommendations, key ones, include a recommendation that a price on carbon be enacted, and importantly so, the report explains the way in which capital markets are not adequately pricing the risks associated with climate change, particularly the risks associated with the use of carbon, and the key need for a carbon price to be enacted as a way of making sure that those costs are appropriately being accounted for in markets and that capital flows are aligned accordingly. But in addition to that, the report makes clear that financial regulators have a lot to do in the US specifically, even if we were to get a carbon price enacted. And some of the recommendations include recommending that the Financial Stability Oversight Council, created in the wake of the financial crisis under the Dodd-Frank Act, that it should incorporate climate-related financial risks into its existing oversight function, that all financial regulators should require bank and non-bank financial firms to include and address climate-related financial risks in those firms' existing risk management frameworks, that financial authorities should consider integrating climate risk into their balance sheet management and asset purchases. Russ mentioned the response to COVID and the way in which COVID is demonstrating the fragility of our economy and financial system. We're all also very aware that financial authorities have intervened significantly with regard to asset purchases and using other mechanisms to try to stabilize markets. The report recommends that integrating climate risk into those decisions is something that ought to be seriously considered. Financial regulators should also undertake, as well as assist financial institutions to undertake their own climate risk stress testing. Stress testing is a tool that financial institutions and regulators are currently doing with regard to broader macroeconomic risks, but a key recommendation in this report is that climate risk ought to be included within, or at least done separately as a part of a way of stress testing the ability of financial institutions to withstand these risks. Financial regulators should require listed companies to disclose emissions. Regulators and policymakers should prescribe a consistent and common set of broad climate risk scenarios, guidelines, and assumptions, and mandate assessment against these scenarios. This is a very key recommendation, underscores the role that financial regulators can play in identifying what set of climate risk scenarios ought to be utilized by financial institutions, so that there's some consistency with regard to reporting as to the results and analysis coming out of the utilization of those climate risk scenarios by financial institutions. And then U.S. financial regulators should join as full members international financial regulatory groups that have been convened to address climate risk, whether it's the Central Banks and Supervisors Network for Greening the Financial System, the Coalition of Finance Ministers for Climate Action, or the Sustainable Insurance Forum. And the report very heavily draws on the practice and experience of these other financial regulators and financial authorities globally, as Commissioner Benham alluded to. And I think understandably, unfortunately, perhaps not understandably, but unfortunately, we find ourselves at a moment in time where U.S. financial regulators are really lagging behind their contemporaries overseas. And very appreciative of Commissioner Benham's drawing on the experience of those regulators as a part of the input to this report. So with that, it's now my pleasure to introduce again Divya Mankikar with CalPERS, who leads their climate risk and sustainable investing practice. And I believe she's going to share with us a bit about a perspective from a financial institution, from a major institutional investor and fiduciary, as to how financial institutions ought to be thinking about climate risk, in particular how this report lends itself to some of the leading work that CalPERS is doing as it relates to climate risk. Divya?
Thanks. It's a pleasure to be part of this panel of esteemed colleagues, and we were really delighted to be nominated to be part of the CFTC Climate Subcommittee. So just wanted to echo those comments that we were proud to see this discussion occurring, and I was honored to represent CalPERS in that discussion. So before I launch into kind of our take on the CFTC report and why it's so important, I thought it would be good to share a bit of context about where CalPERS kind of sits in the world, because that really, these two things really are complementary. So CalPERS is the pension and health benefits fund for about 2 million public employees of the state of California. And we manage, as of today, about $413 billion in assets that are invested across public and private markets and more than 50 markets worldwide. We pay out about $20 billion in retirement benefits annually. And our goal as the investment office, which is where I sit, is to maintain a long-term horizon in order to be able to meet our commitments to our members, which means improving our funding ratio from 70% and hitting a 7% target rate of return annually. So all of that context is useful because it sets out that CalPERS' challenge is to manage our fund not just for short-term sort of gains, but over the long term as we support multiple generations of public employees in California. And also that with this target rate of return and the goal of improving our funding ratio, we really have to be cognizant of systemic risk, not just to the U.S. financial system, but to the global financial system. And so our approach to investing is very grounded in the economic context that we're in, understanding those systemic risks, and also with respect to climate change, grounded in the science of climate change. Of course, our experience living in California, particularly these past few months, but really increasingly over the past few years, is that we all have personal experience of living with climate change. And also working at CalPERS, we're very aware that it's literally our members who are firefighters and other first responders who are on the front lines of responding to climate risk. So that really brings home to us that climate change is real, it's happening as we speak, and it's also a risk over the medium and long term to investors like CalPERS. So our strategy to manage our exposure to such a systemic risk is really grounded in three sort of pillars of activity, and the CFTC report fits into one of those. So just briefly, those pillars are engagement with companies and managers, advocacy with public policymakers and standard setters here in the US and globally, and then integration of climate data and tools into our own investment decision-making process. And we're only able to really go forward on all of those things supported by partnerships, which is why it's great to be speaking with all of you and working with you over the years. So related to advocacy, CalPERS is on the record in support of the Paris Agreement, in advocating for policies that align the global economy with a low carbon transition, that we've advocated to the G7 and G20 governments in favor of. And related to US policy, we were so pleased to see this CFTC subcommittee come to fruition, where we joined 35 other members, a diverse range of views across industry, civil society, other types of investors. So I sort of represented asset owners to some degree, but I think I can really only say I represented CalPERS. But we had other types of investors on the committee as well. And what we landed at is a report that was unanimously supported by that diverse committee and made several recommendations that are super important to CalPERS and actually align with policy recommendations we've been advocating in favor of for years. So in addition to what was highlighted by the earlier speakers, I would say carbon pricing is hugely important to CalPERS in order for us to understand the embedded risk in our portfolio and to be able to make investments in line with a low carbon transition. We really need the externalities to be priced into the value of the assets that we're investing in. And the best mechanism to incentivize that transition and to give us a truer picture of the investment value is through carbon pricing. So that was a key recommendation of the report that we have also been advocating for in sort of other realms. The other one I'd highlight is climate risk reporting. So CalPERS put out our first climate risk report in line with the Financial Stability Board recommendations earlier this year, and I can go in the Q&A section into some of the details and key findings of that report. But that report, putting it together, was really a learning process for CalPERS to understand our climate risk more holistically, even though we have been working on it for years. And what we really need is, in order for us to be able to deploy capital, taking into account our exposure to climate risk, is reporting from portfolio companies and from managers. So that was really important to have in the report as well. And then finally, touching on Chapter 8, as Dave alluded to on the climate solutions, one of the things that we disclosed in our TCFD report earlier this summer is that across private asset classes, we were able to map about 18% of our assets, or $12 billion, to quote unquote climate solutions, sustainably certified real estate, and other such low carbon investments. And that's really helpful for us to be able to track our investments in that space in order to be able to continue to identify such opportunities. But again, it comes back to the other 2 points, that without reporting and without carbon pricing, there are some challenges for investors to go maybe as far as they'd like to in aligning their portfolios with a low carbon transition and ultimately the goal of limiting global warming to well below 2 degrees. So happy to touch on our engagement and integration work in Q&A, but I think that sets out sort of the major areas of activity and how it really links into the CFTC effort.
Thanks, Divya, and thanks for your leadership and CalPERS leadership, both on the Federal Advisory Committee that prepared the report, but more broadly on the issue of climate risks and climate opportunities. Next, we'll have a chance to hear from Imi Granoff with the Climate Works Foundation. Imi, I'm wondering if you can share with our audience a little bit about developments overseas, specifically what other leading financial regulators are doing in other jurisdictions to address climate risk, and then what we can learn from that here in the United States.
Thank you, Dave. It's really an honor to be on this panel with each of you. All of you are really leaders on engaging on climate risk in the capital markets. Dave, in your role as a former insurance commissioner of the state of California, in scrutinizing insurers that represent 80% of the insurance market in the US, and really making sure that they were considering climate risk. The report that has just been issued under your leadership, Commissioner Benham, and Divya, the work that you've done at CalPERS as one of the lead investors, engaging with companies in your portfolio in a proactive way to manage climate risk. So this is really quite an honor. I run the finance program at the Climate Works Foundation. For those of you who don't know Climate Works, it is a global platform to use philanthropy to innovate and accelerate climate solutions. I work on the issue of the intersection of finance and climate change, and have had the honor of working on some of the market-led work that Divya is involved in, and as well as some of the financial policy work. I'm also was not on the on this task force, so that gives me I'm the one participant here who that gives me room to speak on my own behalf. And maybe add some spice to the panel as we go along, because I can speak entirely in my own capacity. A couple things. One is, first, just to note and acknowledge that the CFTC report, task force's report, is really a groundbreaking document. It lays out an extremely clear case as to why climate risk is material and why it requires the attention of firms and of regulators. And in fact provides initial recommendations, quite specific recommendations across the US financial regulatory landscape. So it really is, it is path-breaking in laying that out very clearly, and even includes some fiscal policy recommendations, which we may circle back to. It's also a bit of a catch-up to the rest of the world. The financial regulatory orthodoxy in the last several years has clearly moved on to the point that it is widely understood among central bank supervisors, other regulators, that climate risk, both physical risk and transition risk, is real, that it poses a financial stability risk and a macroeconomic risk, and that squarely places it within the mandate of financial authorities to manage and to manage that risk. And so it should be no surprise that this task force concluded that in fact US regulators also have it within their mandate to address this risk. Now, the conversation internationally, I'll also note, has expanded beyond the question of risk and has started to explore whether financial authorities, including central banks, have a proactive authority to promote green finance and a transition, and whether that's within their mandates or not, and exploration of different legislatures as to whether to change those mandates, et cetera. But what is clear is that the risk is within the mandate, and that is both physical and transition risk. And so this is really, in many ways, a very carefully prepared, nuanced, and analytically sound analysis in the US context of something that the 60+ central banks and supervisors of the network of central banks and supervisors for a green financial system globally have come to conclude. The 4-year-old Sustainable Insurance Forum of Insurance Supervisors that Dave, you had the honor of chairing for a period, and others have come to acknowledge. So it's really kind of bringing the US context up to speed and then providing some US specific recommendations. Just to provide a little more context about what's going on in the world, we also are, in addition to central banks, supervisors, and other regulators exploring these issues and beginning to understand them, for example, through the NGFS, you have many regulators beginning to act on these issues and beginning to scrutinize and manage them. So in addition to the work that Dave Jones, I mentioned that you did in the state of California, you have the UK undertaking, preparing stress tests for its insurance market. the Bank of England and the UK PRA, the Prudential Regulatory Authority. You have about 10 other jurisdictions exploring this, everywhere from the lead regulator for insurance and pensions for all of Europe, EIOPA, to the Japanese Financial Supervisory Authority conducting stress tests. You have really quite a significant Dear CEO letter issued to regulated firms by the UK PRA, and putting those firms on notice that there are significant supervisory expectations on managing climate risk, which, as we all know, is an important precursor to potential future measures if they're not managed properly by those firms. And then you even have institutions like the European Central Bank signaling that they are considering revisiting the core doctrine of market neutrality, either to update how that concept of market neutrality by central banks is conducted to make sure it incorporates these sort of unpriced risks, or potentially to see a more proactive role. So the landscape internationally is shifting quite quickly. I'll also note this is on the financial supervisory side, but even on underpinning that, of course, is the management of climate risk by companies that emit greenhouse gases, and other types of firms that have direct exposure to physical risk. And certainly the securities regulatory landscape is starting to really gear up to engage on climate risk. And so just to bring to your attention for the sake of the discussion here, you have IOSCO, which is the network of securities regulators, has just launched a task force to explore what role they may have in improving sustainability related disclosures. You have the IFRS, which houses the accounting standards body for most of the world other than the US, IASB, has begun a consultation process to explore how and whether they integrate sustainability in their own financial reporting standard setting, which is obviously, again, a precursor to them undertaking that measure, which I can't prejudge, but that is how this process happens. And then you already have that standard setting body, IASB, issuing an opinion last year saying climate change is already a material issue that should be reflected in the accounting disclosures of preparers. So you see it across financial supervision and in the securities market. You already have regulators moving ahead. And I will note, we will be in a situation if we do not engage on this, where you could have very disparate practices and additional complications for firms to the extent that, for example, accounting under GAAP, it doesn't start to consider climate change, and then you have the rest of the world really integrating that in. So there's an added risk to not being tied into those processes and ensuring that there's clear global standards that are well aligned. And all of this, I'll note, the vast majority of this, I should say, is within the framework of financial risk, both narrowly understood in the most narrow definition of financial risk, and also in a slightly broader understanding of financial risk that considers longer timeframes or longer timeframes and sort of larger feedback loops. There are jurisdictions that are exploring whether to mandate disclosure of non-financial risks, like in Europe. There are central banks that are considering whether they have a role in green finance promotion. But at the same time, what's clear is underpinning all that is a clear understanding the risk has to be grappled with. And so I'll just note my one last observation here on action and implementation of these recommendations, which is just that what we're seeing is, there's a lot of questions and even concerns about whether we have the tools, the analytical underpinnings, the quantification of the risk to implement measures like capital adequacy requirement changes, risk weighting, et cetera, very proactive measures to manage those risks. The reality is that we don't know what measures to take to reduce financial stability risk from climate change is a signal to begin scrutinizing, not to fail to act. And where we are now is that many regulators have not begun to collect the data they need to understand the issue. And so where we are now is the really urgent need for financial regulators across the board to start collecting that data from regulated firms, to start scrutinizing it. There are many tools in the toolkit to do that. And the regulatory burdens I'll add to data collection, regardless of what banks and insurers tell you, is relatively low. It's kind of my prerogative not being on the commission to note that. So it's really high time to begin doing that, regardless of what other future measures are taken, is to begin that process right away. And that data collection and then guidance to the market as we understand the issue better, to start pointing the market towards grappling with these risks. And there's plenty of precedent for very sector-specific guidance from financial supervisors, and climate is no different. So with that, I'll open it up to discussion for you.
Thanks, Imi, and really appreciate your providing such a deep perspective with regard to what's going on in other jurisdictions. And I'll note that the CFTC report did not shy away from looking at and drawing on the work that you described in a lot of detail, and I think thankfully so. And I think one of the unanimously agreed upon approaches that's captured in the report is the importance of consistency globally with regard to how to address these issues. There may be some US specific risks with regard to certain perils that may need to be taken account of, but in terms of the overarching approach, there was a lot of interest in consistency and drawing on the experience of other regulators. Commissioner Benham, I know it's early days. The report was only released in September, and so I'm curious though what has been the reaction of other U.S. financial regulators. The report has specific recommendations for the Federal Reserve, for the SEC, for the Office of Controller of Currency, for the Department of Labor and its role regulating ERISA, for state insurance regulators, and that's just a partial list. And so I think it importantly is very comprehensive, but I'm interested in your sense in terms of what kind of reaction you've gotten from your colleagues, what sort of reaction you're getting from financial institutions, and then where you'd like to see us in the next year or two.
Thanks, Dave. My gut reaction to the question is that the response has been positive. Now, a lot of the viewers, and I've gotten this question before, what does this report mean? Are we going to see action now? Does it mean it's the new rule now? And in short, these are recommendations, as been pointed out by the others on the panel. And as I suggested in the sort of intro remarks I provided, this is raising awareness. And the one thing I am certainly heartened by with respect to my colleagues across the sort of federal financial regulatory field is that everyone has been very open-minded, is very appreciative of the report, and wants to take a look at it, see how and if it applies to them, and to what extent action in their view is necessary and can be acted upon. In the short term, and this is a little bit of a lesson in bureaucracy, I don't think this is going to be a surprise to anyone, there are only a few things that can be acted on in the short term in terms of the recommendations. One, Dave, you pointed out the NGFS, which Imi mentioned as well, is a sort of consortium of central banks and supervisors under the sort of auspices of the Paris Accord. And that's an easy sort of action item that the US could do from a Federal Reserve perspective to join it. The others will require a bit of work and examination within the processes that we have within the government. But I am confident that my fellow regulators are going to look at this report, digest it, and try to understand it, analyze it, and take action if they feel it's necessary. I do want to point out, and you mentioned this, and I think everyone, and at least Divya mentioned it as well, is the vote, the 34-0 vote. And from my perspective, this dovetails nicely with your question, because as I mentioned sort of briefly at the beginning, my number one goal was to build a broad coalition, right? To get as diverse a coalition of members to support the underlying thesis that climate change poses a financial stability risk to the US financial system, and what we believe, underpins the support of the US economy. And to have as many members of the sort of real economy, the financial markets, support this unanimously, it sends a clear message, I think, to policymakers and elected officials that action is required from the public sector. Climate change is not it's not linear. The risks that we're going to face are going to vary over time. We have to adapt. We have to adjust in the short term, the midterm, and the long term. And certainly, and another lesson from the pandemic is that the private market can't handle this itself, in my view. And I think a lot would agree. We need a smart, efficient, well thought out, well prepared public-private partnership where we're going to work together, use the resources, the data, which Imi mentioned that the government has a lot of access to and can collaborate, can convene and collect. And we need to work together in order to put together a plan that would effectively mitigate this risk. So I think the response has been positive, certainly domestically, definitely internationally, as I pointed out, the response has been very positive, I think, sending a signal to the international community. But the vote, certainly the 34-0 vote, was a great victory. I mean, that's just the bottom line. And it is a recognition and kudos to the members, including you and Divya, because one thing I've heard frequently, which is almost it's a rare thing to hear these days in DC, but this is not exactly the report I would write, but it's a really, really good report. And what that means to me is that's compromise, that's concessions, that's a willingness to understand and appreciate an underlying and fundamental belief that we have a challenge ahead of us as a country and that we need to work together, even though it's not necessarily and clearly in the best interest of each of the individuals, the organizations, or the academic institutions that back the members. So I think there's a lot of good takeaways from the report, including obviously the 53 recommendations, but the message it sends broadly. And I'm hopeful, to sort of circle back to your question, Dave, that all of that taken together will really push the conversation in DC in terms of the importance of this issue, the recognition by the private market and the real economy of the risks that we face as a country, and the practical reality that we have to take action sooner than later before it's too late.
Well, great, and I couldn't agree more. I mean, I really think it is and should be required reading for every U.S. financial regulator. And I can say this as a former regulator, I really think it would be financial regulatory malpractice not to take up the recommendations in this report, because they're so well grounded, so well supported, and so necessary. So again, kudos Commissioner Benham for leading the effort and for driving this forward. Divya, I know that there are a number of asset owners who are moving ahead with addressing climate risks, but also working to try to align their own investment portfolios with a net zero emissions result, if you will. And I'm wondering, CalPERS and you led in the creation of the Net Zero Asset Owners Coalition, which was announced, I believe, last year. And I'm wondering if you could share with us a little bit about that coalition and some recent developments that were announced about how it's going to begin to approach its framework with regard to trying to reach that objective of net zero emissions.
Sure, happy to. Thank you. So the Net Zero Asset Owner Alliance is a voluntary commitment by asset owners representing a number of different countries at the moment, and I believe about $5 trillion worth of assets under management, who are working together to figure out how to align portfolios with a net zero by 2050 goal. And similar to the sort of three activities that I laid out earlier of engagement, policy advocacy, and integration, the Asset Owner Alliance has a similar framework. So for example, within the engagement track, there's a lot of different platforms are sort of coming together in this coalition. So another initiative that we are part of and actually help to convene and are co-founders of is Climate Action 100+. And that coalition is of 518 and possibly more now investors representing more than $47 trillion of assets, who are engaging 161 companies that are systemically important carbon emitters and other companies that are kind of regionally important for bringing down emissions. if you took just the top 100 emitters on that list and combine their scope 1 and 2 emissions, you would have a set of emissions that would make that group the 3rd largest country by emissions in the world. So this is an important initiative where we are pleased to be on the steering committee and the inaugural chair of the Climate Action 100 Plus, and we're working with investors around the world to engage companies to have them set emission reduction targets, put in place the governance so that they have climate oversight, and then report in line with the TCFD recommendations. That Climate Action 100 Plus is a key pillar also of the Asset Owner Alliance engagement working group. So that's why I bring that up. And so far, Climate Action 100 Plus has achieved, 120 companies that have nominated a board member with climate, or a board committee with climate oversight responsibilities, 50 companies that have indicated they will aim to achieve net zero emissions by 2050 or sooner, and 59 companies that have formally supported TCFD disclosure. And we're in about year three of that 5-year Climate Action 100 Plus initiative. So plenty more work to do. But I think, these things are building on each other. And to Ilmi's point about how climate action in the financial sector has taken on momentum globally, these are some of the data points as evidence of that we launched Climate Action 100 Plus in December of 2017, and the assets have steadily grown in terms of investors who are part of it. And then 2 years later, we have the Asset Owner Alliance, where Climate Action 100 Plus is a piece of an even bigger commitment. So also within the Asset Owner Alliance, we're working on policy. Several members, including CalPERS, are part of the IFRS investor standards body that Omi mentioned, that have put climate change really on the agenda for the IFRS. And then within integration, there's a lot of discussion around how to set targets, how to do scenario analysis for the portfolios that these members manage. And to be honest, that's an early conversation where there's a lot of testing and piloting of tools, reviewing scientific information, reviewing the emissions of the real economy, because in most cases, the asset owners' portfolios reflect the real economy. And so that's really where we need to see emissions reduced and physical climate risk resilience improved. For assets, asset owners as large as CalPERS and the other peers in the Alliance, there's nowhere for us to hide, or for our portfolios to hide from climate change. So it takes a lot of policy and engagement at a global scale in partnership with peer asset owners in order to really mitigate our exposure to the risk.
Thanks, Divya. And I think that's a great way to capture a key aspect of the report. There's no place to hide with regard to these risks. I mean, they're manifesting themselves in the real economy as well as in the financial sector. And it's exciting to learn about the efforts of CalPERS and other asset owners, as well as the engagement of CalPERS and others with the real economy to seek to move them both to disclose more, but also to take steps to try to deal with the underlying greenhouse gas emissions that are driving climate change. Ilmi, one of the key recommendations in the CFTC report is that financial regulators and financial institutions should use climate risk scenario analysis to understand the risks they're facing in their portfolios, in their investments. I'm wondering if you could just generally share what some of the latest developments are internationally with regard to generally what those climate risk scenarios should include.
Sure. So just first level setting context around why scenario analysis is so important to this. There was a recent really seminal paper on understanding climate risk in the capital markets called Green Swamp. It's called, excuse me, got to get the name right here, The Green Swan, and published by the Bank of International Settlements. A key point in that paper is, to quote it, extrapolating from historic trends will inherently misprice climate risk. So we have an empiricism problem where a lot of the quantification we do in the financial sector on the supervisory side and at the firm level looks at past data. That's how empiricism works. And yet the nature of climate change is that we know that that will misprice risk. Scenario analysis is a tool to help navigate that. The challenge is that modeling for climate scenarios is incredibly complex. And a lot of the tools that we've developed have been really targeted in informing policymakers to choose the sort of best path to have a policy outcome, not really designed for policy takers like supervisory authorities or firms to navigate physical risk and an increasingly dynamic techno-economic and regulatory environment. So there are a couple things on the horizon to help with that. The Task Force on Climate-Related Financial Disclosure is actually in the process of issuing further recommendations related to scenario analysis. And I think that's going to be an important voice of the market as to how that, how those issues are understood. But also the NGFS has undertaken a process to develop a set of coordinated scenarios that, or what they're calling reference scenarios, but that are basically some standardized scenarios that could be the basis for being clearer when firms apply scenario analysis around what assumptions are made in those scenarios. So the first round of those scenarios were issued earlier this year, and there will be an additional one at the end of this year, or the very beginning of the following of 2021, that set forth a set of scenarios where we can kind of standardize those expectations so it's not quite as Wild West on scenario analysis. The challenge here is that we're actually trying to do a lot of different things with scenario analysis at the same time, and this isn't always particularly well understood, so I'll highlight some of those issues. One is a lot of the application in the supervisory, financial supervisory context is applying scenario analysis to stress testing, understanding tail risks. Many of the gravest risks that climate change poses are sort of fat tail risks, very significant harms at the sort of tail ends of probability. A lot of the models that we use focus on high probability events, so don't capture those lower probability catastrophic events. So we need to make sure that our scenarios are capturing those. But also stress testing is capturing, again, sort of 5% probabilities. And the reality is that both the physical risks are beginning to crystallize and the regulatory and techno-economic environment is changing such that we kind of need to use scenario analysis to update our core expectations, our base case. What is the forecast of the policy and techno-economic environment we're operating in? So the NGFS work has been really good at creating an array of scenarios that we could use for stress testing from supervisors. At the same time, and we've had the opportunity through Inspire, a platform that ClimateWorks is involved in to help support the work of the NGFS to help develop those scenarios. But at the same time, we've been working with the UN Principles of Responsible Investing to develop a scenario that is based on a credible policy forecast and techno-economic forecast that captures transition risk and starts to inform firms as to what the base case looks like. This is not tail risk. This is the environment we will operate in. The only way that we achieve climate stability is to achieve net zero emissions, to largely decarbonize the economy and then offset a small amount of those emissions. Otherwise, the wheels come off the bus and there's no market. So assuming that it will happen, as it delays, it just becomes more likely and more dynamic a regulatory environment. And beginning to model that is actually sort of core to base case expectations for the market. So we have sort of two purposes that are developing at the same time. That scenario is called the forecast policy scenario under a project called the Inevitable Policy Response. And it's sort of targeted at firms that are just trying to get a clearer view of where we're headed. And it can inform that. And then I'll just finally say, yes, it's early days in terms of applying this to portfolios. But the reality is there are some good tools to get started. 2 Degree Investing Initiative has the PACTA tool, which makes it pretty easy for investors and increasingly banks to have a good view of carbon exposure on a forward-looking basis over their portfolio. MSCI and Carbon Delta also have a tool that analyzes value at risk over time. So there's some pretty good tools. Now, we know risk is not captured by just carbon exposure. There are a lot of other factors that will make a firm in a portfolio risky than just even to transition risk than exposure. So there's a lot more work to be done. But even at a baseline, the transaction costs of just getting a view are actually very low already.
Thanks very much, Imi. So I want to take a couple of questions that have been posed over the Q&A from our audience members. One question is, in light of the CFTC report, to what extent is it the case that inadequately addressing climate risks in reports to shareholders, say, may result in a failure of legal duty or responsibility to board directors or corporate officers. So I don't know if anybody wants to take a stab at that.
I'll take a quick jump in. Divya, go ahead.
Yeah, I was going to say, I guess representing share owners in some capacity, it's an issue that we are aware of in terms of litigation risk, and it's a key reason to be engaging companies. Litigation risk also represents risk to share owners for a number of different reasons. And so what I would say is the response to that in terms of what can share owners do is to be active owners, engaging companies that they feel are highly exposed. It could be the Climate Action 100 plus list of companies that was developed based on emissions, but there are so many other climate factors. There could be, another investor's view of physical risks, for example, which companies are most exposed. So I think investors are aware that that risk exists, and the solution is to be in active discussion with boards and seeking an audience with the boards of companies, of portfolio companies, in order to make sure that they have oversight.
Russ, did you want to add something?
Yeah, I would say, I agree with Divya on that front, but, I think this question raises issues around, the current rule set with respect to climate risk, climate obligations, with respect to disclosures. And I think if we were, as a regulatory body and as a financial market, going to take steps towards more defined, clear rules regarding climate risk and climate disclosures, then I think that case law would clearly develop over time in terms of what fiduciary responsibilities the board or the governance committees or any executive at a public company has to its shareholders. So totally valid points, things that I know people are thinking about extremely, but just I think really highlights the issues and the challenges we have from a rules perspective, from a markets regulator perspective, a supervisor, and a Fed perspective. And I know we're wrapping up here, and hopefully we can take another question, but Dave, I did want to give a quick shout out to the chair of the subcommittee. We didn't mention Bob Litterman, but he was a key member as the chair. And for those of you who don't know him, I would look him up. He's produced a lot of literature, but he was in many respects the perfect chair for this group because he has decades of experience as a risk manager at Goldman Sachs, as an asset manager also, but has really dedicated the past 10 years of his life thinking about climate change and the intersection between financial markets, risk management, asset management, and climate change. So he deserves a lot of credit, and he's been a great partner with me, and I know for the committee as well, and getting to the finish line and getting to where we are today.
He did a fantastic job. Let me pose one more question and then we'll have to close. We have a question that notes that divestment is only mentioned once, according to the questioner, in a footnote on Norges Bank. And the question is, what is the place of fossil fuel divestment in mitigating risk to the financial system? Anybody like to take that?
I think it's obviously a key element, but it really isn't the focus of the report. Probably why, and I think this is what you were referencing, Dave, that it's not specifically in the report as a policy recommendation. I think it's important to, and I get these questions a lot. It's easy to sort of go outside the scope, and not at all underestimating the importance of divestment in the short term and the long term in order to address climate change writ large. But I think from the context of this report, from my shoes as a financial regulator, we're trying to make observations about the financial system, its financial market participants, potential climate risk horizons in the short and long term, and what I can do as a regulator and my colleagues can do to address these risks through, mostly regulatory policy, but Ilmi pointed out, obviously, monetary policy, fiscal policy to the extent it's possible. So important issue, good point, but I would say my direct response would be a little bit outside the scope of the direct mandate that I asked the committee to address.
Divya, did you want to add something from CalPERS perspective, or Ilmi?
Yeah, I was just going to say it's one of the tools investors have at their disposal. Our approach is that we have divested from thermal coal mining companies and other companies related to different sustainability risks. But what we really have is a shortage of engaged asset owners and not a shortage of financial capital. So it's one tool that some of our peers use, but what we find is the most impactful for mitigating our exposure to risk is to be really investing in engaging companies and seeing them through a transition in line with a low carbon economy, which can only happen if you stay at the table as a share owner.
Ilmi?
I'll try to be quick looking at the time. Two observations, just one on the fiduciary duty point, which is common law jurisdiction. The US is a common law jurisdiction. The norm is clearly evolving. And as Commissioner Benham points out, that case law will evolve. The other vector that can change fiduciary duty quickly is legislation. If the norm isn't already that these are fiduciary duties that have to be taken into account by officers of a firm, financial or non-financial, it's very clear that should be on the horizon, and that a dutiful officer will be aware of the risk that norm changes in the U.S. and certainly in other jurisdictions that are not based on common law. The norms are being explored and have been changed even in a few jurisdictions. On the issue of divestment, I think part of the reason, I'm reading into the pause that maybe the panelists we've all had on that for a second, which is that divestment is a pretty blanket term. Clearly, a financial firm that has a lending or investment portfolio that's looking at managing climate risk has to evaluate its exposure to both carbon, physical risk, and other pathways through which climate risk manifests in that portfolio. There are many different methodologies to reweight that portfolio to reduce exposure to that risk or to engage with companies. And so I think the issue with a divestment is it's a very blanket term. There are clearly cases where it's warranted. I mean, I'll point to the California insurance market again and say, Dave, when you were serving as commissioner, you made a recommendation to the whole market to divest from coal on the basis that it was clearly in structural decline. That was different than the work that you did to analyze climate risk across the portfolio in a more systemic way that didn't say divest from all exposure to carbon, but it said, here's a case where we're in structural decline. And I imagine as we move forward, it will start to identify clear subsectors that do pose financial risks in a way that warrant changing exposure or changing how supervisors evaluate risk associated with those sectors. That seems inevitable, but it's probably not going to be, blanket across all fossil fuels tomorrow either. So that would be my response.
That makes a lot of sense. I guess the other thing I'd add on the fiduciary duty question is there are competing views on this, but there's a strong view. Principles for Responsible Investment, for example, has done a lot of legal research to support the view that it's already a part of fiduciary duty to broadly consider ESG impacts in making investment decisions, and certainly climate risk falls within that. There are competing views on that issue. And on the divestment question, yeah, I mean, as a regulator, not as a campaigner, but as a financial regulator, I reached a conclusion that thermal coal was not an investment that was going to retain value over time, given what was occurring in the market, given what was happening from a regulatory standpoint. And so I did recommend that insurers get out of thermal coal because my job at that time as insurance commissioner was to make sure they were invested in things that would retain value and not lose value. This has been a fantastic panel. I want to thank Ilmi, Divya, Commissioner Benham. A very rich discussion. I think we could probably go on for another 2 hours. I'm sorry we weren't able to get to all of the audience questions. I do want to encourage people to take a look at the report. There's a lot in there. It is heavily annotated and heavily footnoted, so you can actually dig deeply into the source material. But in particular, pay attention to the recommendations. And they're critically important and really provide a roadmap for the U.S. Federal and state financial regulatory system in terms of how to address these risks. I'm going to give Commissioner Benham the last word. And again, I want to thank him for his tremendous leadership in sponsoring this report and bringing it to fruition. Commissioner Benham?
Thanks, Dave. And I'm going to get a little technical, then I'll pull it back. But you made a point about fiduciary responsibility and the argument on both sides, because many can argue that there is a current fiduciary responsibility under the current sort of remit, others won't. And it reminds me of the disclosure discussion that is going on within the context of the materiality standard at the Securities and Exchange Commission and Reg SK. Point being, and I'm not going to get into the nuances because again, you can make strong arguments on either side. And regardless of what I think, and I think the other members, regardless of the final point of view, the conclusive point is we need clarity. We need certainty. We need to think about these issues deeper because it's going to create uncertainty for both regulators, investors, and ultimately the general population, whether it's the investing community or citizens across the country. And we need clarity on climate risk because it's unique, it's different, it's nonlinear, it's not traditional, and we need to start thinking about these issues in a very different way. And again, thanks to all of you for participating on this panel. Certainly Dave and Divya for being a part of the conversation and the subcommittee's work, Ilmi for all of the work that you do to start thinking about these issues. But I'm confident, I'm proud of the work that the subcommittee was able to accomplish in a unanimous forum and in a unanimous way. And I think it's going to really put us as a country, but then as a sort of ecosystem of both climate advocates and the financial system participants in much better footing, because we need to act quickly to create this clarity, to create this certainty, to build that resilience in our financial system, because it's just too important given the climate risks that we're facing every day.
Fantastic, fantastic close. So on behalf of the Center for Law, Energy, and the Environment and the Center for Business and Law at UC Berkeley School of Law, I want to thank our panelists, thank our audience. You'll be able to access the recording of the webinar at the Center for Law, Energy, and the Environment's website. Do take a look at the report and very, very excited about the opportunity it presents for U.S. financial regulators, financial institutions to begin to robustly address these systemic risks. Thanks again, everybody.
Thanks, everyone.
Bye-bye now.